Happy Friday, Brian Manning here with the weekly update. Let's get right to it. So Monday this week, not anything to report there as Columbus Day, so all financial markets were closed. Tuesday and on this week just started the sell-off in the stock market. So if you look at this, it really started around October 3rd, just exacerbated coming into this week, and then just some big plunges there in the stock market. Thursday this week, we got inflation information. So there's really a couple of gauges of inflation we look at. What we got this week is the CPI, that's the Consumer Price Index. So from the mortgage lending side, I really think that's probably the more accurate of one. The reason why is because CPI is inclusive of cost to us as consumers for out-of-pocket medical expenses and also the cost of living expenses. So on a year-over-year basis, CPI dropped from 2.7 to 2.3%. So really tame inflation data. Probably a lot of this drop was from energy costs falling around 0.5% as well. Now, if we look at the core rate, so the core rate looks at inflation on a year-over-year basis, but strips out the volatile food and energy costs, the core rate remains stable at 2.2%. So really good to see inflation remaining tame, because inflation is certainly the enemy of the bond markets, and high inflation causes mortgage rates to go up. Today on Friday, it's all about the stock market. So if stocks really rebound today, you're probably going to see investors take money out of the bond market, invest into stocks, and likely that would have a negative impact on mortgage rates. So all eyes are still on stocks today, because stocks are going to be the biggest mover of the bond markets and in the end result of interest rates. I'm around all weekend. If you have any questions, let me know. We'd love to help you any way I can. Happy Friday. Have a great day.